Welcome back. The topic for the day is here we are trying to analyze how technological developments will affect the calculation of variances. Now, artificial intelligence or AI is affecting many walks of life. You could be playing chess with your computer, or you could have certain self-driving features in your vehicles. Now, the scenario that we're going to explore today is when the company has bought a new robot, which will replace majority of the labor force. Now, whenever we calculate the variances, we compare the original budget or the original standard with the actual results, correct? But if there is a technological development, then this original budget or standard will become worthless, and we will have to create a new or a revised standard and then compare it with the actual results. Only then it will be meaningful. What we will do to start off with the answer is we will compare the original budget or the original standard with the actual results. And then we will move on to revising the budget and calculating the planning variances and the operational variances. So let's get to the question extracts. Now, the format that I want you to follow for the direct labor variances is something like this. So direct labor cost, as you know, it is the hours multiplied by the rate. And for any kind of variance, you have to compare the actual cost with the standard cost, correct? And I said you have to take the original standard because for the time we are ignoring the invention of the robot, the AT. So the actual cost is the actual hours multiplied by the actual rate. And the standard cost is the standard hours multiplied by the standard rate. And always take note of the actual production from the question, because the actual cost is for the actual production. So the standard should also be for the actual production. Say the actual cost is for 10 units, then the standards should also be for 10 units, or it will not be comparable. And usually in the question, the direct labor hours required per unit as per the standard will be given. So I want you to take note of it here. Only then the information from the question will be complete. Now let's look into the question extracts. The standard labor cost for product A is $30. Labor cost. Labor cost is always hours multiplied by rate. So the labor cost is $30. And the standard labor time per unit is 3 hours. See, the direct labor hours required per unit as per the original standard has been given. So 3 hours will come here. Now, it's already mentioned that the standard labor cost is $30. That is hours multiplied by rate. We already know the number of hours. It is 3. 3 multiplied by rate is equal to $30. So what is the rate? Rate is definitely $10 per hour. So that will come against the standard rate. Now, moving to the next sentence. Last month, your company's budgeted production was 8,000 units. We don't need the budgeted production for variance analysis. What we need is the actual production. Though actual production was 10,000 units. This is what we need. So we will key in 10,000 units in our format. Actual hours taken equal to 7,000 hours. So against actual hours, we will write 7,000. And the total labor cost was 77,500. So that's the actual cost that will come here. So the information from the question, we have keyed it into the format. Now we will find all the missing figures. Now 3 hours is the direct labor hours required for 1 unit. But the actual production is for 10,000 units. So for 10,000 units, how many hours are required? So it is 3 multiplied by 10,000 units, or it is 30,000 hours. And that will come as the standard hours, or that is a maximum time that the laborers should take for manufacturing 10,000 units. And what is the actual rate? It is 77,500 divided by 7,000. If you get a number with decimal places, please take at least 5 decimal places. Do not round it off, because if you round it off, then your final answer will differ by $30 or $40. So we don't want to take a chance. So the answer works out to 11.07143. Please do not round it off. Now, the standard cost for making 10,000 units is 30,000 multiplied by $10 or $300,000. Now, the difference between the standard cost and the actual cost is 222,500. This is because of 2 reasons. One is because the rate is different from the standard, and one is the hours taken is different from the standard. So basically, we have got 2 types of variances. One is the direct labor rate variance, and the next is the direct labor efficiency variance. Now, the direct labor rate variance, as the name indicates, it measures whether the actual rate is more or less than the standard rate. So the standard rate was only $10 and the actual rate is 11.07. Which means that we have paid $1.07 extra for every hour that the laborers have worked. And how many hours did the laborers work? 7,000 hours. So as a formula, if you have to write the direct labor rate variance, it is the standard rate minus the actual rate multiplied by the actual hours. So substituting those figures in the formula, we get $10 minus 11.07143 multiplied by 7,000 hours. So the answer works out to $7,500 adverse. And why is it an adverse variance? Simply because the standard stipulated paying only $10 per hour. But what was the actual rate of payment? It was 11.07. Since the company paid more than the standard, it is an adverse variance. And even if you solve this, you are ending up with a negative balance. If it's a negative balance, then it is an adverse variance. Now coming to the efficiency variance. Now, how do you measure the efficiency of laborers? Forget about laborers. How do we measure our efficiency? Now, if you can do a problem accurately in lesser time than others, then you are definitely efficient, correct? That is exactly the same logic that we are applying in variance analysis. If the laborers can manufacture a quality product in lesser time, then they are considered more efficient. So the efficiency variance is measured by calculating the difference between the standard hours and the actual hours. That is the hours that they should have taken and the hours that they've actually taken. Now, in this particular case, the standard hours was 30,000 hours for making 10,000 units. And how many hours did the laborers take? They took just 7,000 hours. So there is a savings of 23,000 hours. That is 30,000 hours minus 7,000 hours. So that's the variance. But we don't want the variance in hours alone. We have to convert it into dollar terms. So to convert it into dollar terms, we have to multiply it with the standard rate of $10. So as a formula, if we have to write, the direct labor efficiency variance is the standard hours minus the actual hours multiplied by the standard rate. Now, can you tell me why we are taking the standard rate and not the actual rate for converting it into dollar terms? The reason is simple. The actual rate is the responsibility of the HR manager, and the efficiency variance is the responsibility of the production manager. So just because the HR people have paid a higher rate, for whatever reason, you cannot penalize the production manager for that. So that is why we have to always multiply the efficiency variance obtained in hours with the standard rate per hour. So substituting the figures in the formula, standard hours is 30,000 hours, actual hours is 7,000, and the standard rate is $10. We get the variance as 230,000 favorable. And why is it favorable? Because the actual hours taken is lesser than the standard hours. And even when you solve this, you are ending with a positive balance, which indicates that the variance is favorable. Let's cross-check our answers. Direct labor efficiency variance is 230,000 favorable. And direct labor rate variance is 7,500 adverse. So 230,000 minus 7,500 is 222,500, which is the total direct labor variance. So our answers are right. So what we just completed is the traditional method of calculating the variances. But I said in the intro that the company has bought a new robot. That is the reason why there is a savings in the actual labor hours. So let's get to the details and we will then calculate the revised budget and then we will split the direct labor rate and the efficiency variances into the planning variance and also the operational variance. Okay, so here we come to the second extract of the question where the company has bought a new robot. The company bought robot T80 as a substitute for 80 laborers who were shifted to the production of other products, thereby saving 24,000 labor hours each month. So what has happened? The company bought a new robot, due to which 80 laborers could be shifted to the production of some other product. And thereby, for the current product, there was a savings of 24,000 labor hours per month because the robot will do their job. Now, the balanced direct laborers, that is the laborers who were not shifted, who became AI trained. What is AI? AI is artificial intelligence. So when a new robot has been bought, the remaining workers had to be trained to handle this robot and they had to be given a pay rise of 10%. So because of the additional job of handling the robot, plus due to their AI knowledge, the remaining laborers had to be given a pay rise of 10%. So in short, what are the two modifications that happened in the budget? One is the savings of 24,000 of labor hours per month and the laborers being given a pay rise of 10%. So we will create the revised budget. So revised budget, I will write it in the center. Now for the revised budget also we need the standard hours and the standard rate. So for the revised budget, we will name it the revised standard hours and the revised standard rate. And for the original standard, we will use original standard hours and original standard rate. So the short forms have been given on the right side. RSH stands for revised standard hours. RSR stands for revised standard rate. OSH is original standard hours and OSR is original standard rate. And as you already know, AH stands for actual hours and AR stands for actual rate. Now we will key in the figures. What have they said in the question? There is a savings of 24,000 labor hours, which means that the direct labor hours will not take 30,000 labor hours. They will take 30,000 minus 24,000 because 24,000 labor hours have been saved. So 30,000 minus 24,000 labor hours gives 6,000 labor hours as the revised standard hours. And what about the revised standard rate? They have said that the AI trained laborers will be given a pay rise of 10%. So right now they are given $10 per hour. So $10 into 10%, the increment is $1 per hour. So what is the revised standard rate? It is 10 plus 1 or $11 per hour. So now we have got a revised standard hours at the revised standard rate. So our format is complete. Now the difference between the original standard and the revised standard causes the planning variance, and the difference between the revised standard and the actual cost results in the operational variance. So first we will focus on the direct labor rate variance and we will split it into the planning variance and the operational variance. Now, how did we calculate the direct labor rate variance in total? We compared the original standard rate of $10 with the actual rate of 11.07. And we found out the difference That is $1.07 per hour was paid extra. Paid extra for how many hours? For the actual hours of 7,000. Now we know that the situations have changed after the purchase of the robot, and the per hour labor rate is $11 and not $10. So now we have to split the direct labor rate variance into the operational variance and the planning variance. For the operational variance, we have to compare the revised standards with the actuals, correct? So in the formula, inside the bracket, just take 11 and 11.07. What is 11? 11 is the revised standard rate. And what is 11.07? That is the actual rate. And multiplied with the actual hours. Outside the bracket, please do not change. And as for planning variance, we are supposed to compare the original standard with the revised standard. So the rate as per the original standard is 10 and the revised standard rate is 11. So it is 10 minus 11 for how many hours? Multiplied by 7,000. That is the actual hours. Please note that outside the bracket, it will always be the actual hours of 7,000 hours. Now, as a formula, if we have to write, the operational variance is the revised standard rate minus the actual rate multiplied by actual hours. And the formula for planning variance is the original standard rate minus the revised standard rate multiplied by actual hours. So the answer works out to $500 adverse for the operational variance. Why is it adverse? Because we have paid $11.07 for every hour instead of $11 that was prescribed as per the revised standard. So that is why it is an adverse variance. And even if you solve this, you end up with a negative balance. So we can confirm that it is an adverse variance. And as for the planning variance, it works out to $7,000 adverse. Why is it adverse? Because the original rate was just $10. But when we had to revise, we had to pay $11 per hour to the laborers. So that is causing the adverse variance. And even when you solve this, you end up with a negative balance. So you can confirm that the variance is adverse. And if you have to cross-check, operational variance $500 adverse plus planning variance $7,000 adverse gives a total amount of $7,500 adverse, which is exactly tallying with the direct labor rate variance in total. Now moving to the direct labor efficiency variance. Here again, we have to split it into the planning variance and the operational variance. What did we do in the total formula? We compared the original standard hours with the actual hours. That is 30,000 was getting compared with 7,000 hours. See the formula? And then we multiplied it with the original standard rate of $10. That is how we converted it into dollar terms. Now, if you have to split it into the operational variance and the planning variance, the operational variance, as you know, it is comparison of the revised standard with the actuals. So inside the bracket, compare 6,000 hours with 7,000 hours. So we shall write that operational variance is 6,000 hours, which is the revised standard hours, minus 7,000 hours, which is the actual hours. And outside the bracket, it will always be the original standard rate of $10. So the answer works out to $10,000 adverse. Why is it adverse? Because the revised standard prescribed the laborers to do the work in just 6,000 hours. But how many hours did they actually take? They took more hours. That is, they took 7,000 hours. So that is why it is an adverse variance. And even when you solve this, we are ending with a negative balance. So we can confirm that it is an adverse variance. And as a formula, if you have to write, it is the revised standard hours minus the actual hours multiplied by original standard rate. And what about the planning variance? Planning variance, we are comparing the original standard with the revised standard. So it will be the original standard hours of 30,000 compared with the revised standard of 6,000 inside the bracket. So we will write that it is 30,000 minus 6,000. And to convert it into dollar terms, we have to anyway multiply it with the original standard rate of $10. So the answer works out to 240,000 favorable. Why is it favorable? Because the original standard prescribed 30,000 hours. But after the purchase of the robot, the revised standard hours reduced substantially to just 6,000 hours. So we are making a savings there. So that is why we have ended up with a favorable balance. And even when you solve this, you are ending with a positive balance. So we can confirm that the variance is favorable. And as a formula, if you have to write, it is the original standard hours minus the revised standard hours multiplied by the original standard rate. So if you have to cross-check your answer, planning variance 240,000 favorable, netted off with 10,000 adverse. So 240 minus 10, it is 230,000 favorable, which is the total direct labor efficiency variance. So our answers are right. Now, totally, I have put up 3 planning and operational variances videos in my channel. One was related to sales and one was related to the direct material, and the current session, it is related to direct labor. Now, all these 3 have been constructed in the same format. But one point of difference that I want you to notice, sales is a revenue and the direct material and the direct labor are the cost. So for all the formulas relating to sales, if it is the operational variance, it is actual selling price minus revised budgeted selling price. Actual selling price is the top figure and the revised budgeted selling price is the bottom figure inside the bracket. And for the planning variance, it is the revised budgeted selling price minus the original budgeted selling price, which is inside the bracket. That is, the top figure has been written first and the bottom figure has been written as the second item inside the bracket. So this is the format that you have to follow for sales. Only then you will get a positive balance for all favorable variances and negative balance for adverse variances. Please don't do the reverse. That is, don't write the bottom figure first inside the bracket. But for the other two, that is those variances relating to the cost. Now for direct material, for the operational variance, what was the formula? It was the revised standard price minus the actual price. That is, the bottom figure has been written first and the top figure has been written next. Which means that if it's a cost variance, you have to write the bottom figure first. Only then you will get a positive balance for the favorable variances and the negative balance for the adverse variances. This is the same thing that we are applying in direct labor also. Let's take a look at the formulas. For the operational variance, it is revised standard rate minus the actual rate. See, the bottom figure has been written as the first item and the top figure has been written as the second item. So this is because direct labor is a cost. So as I said, only then will you get a positive balance for the favorable variances and a negative balance for the adverse variances. So this is a fine point of difference between the formulas of sales on one side and the direct material and direct labor on the other side. And one more point that you have to always remember is, in the question, the budgeted production will be given, the actual production will be given. Always take note of the actual production at the very top, and whenever you calculate the original standard hours or the revised standard hours, it should always be for the actual production. That is, how many hours are required as per standard for the actual production, not for the budgeted production. This is something that I've already said in the direct material planning and operational variances video. This is something that you have to follow in the planning and operational variances of direct labor as well. So that is why I have added this note. The revised standard hours and the original standard hours is calculated for the actual production. So here we come to an end of today's session. Stay tuned for the recap ahead.